The Consumer Price Index just hit 330.293 in March 2026. That is not a typo. That single number is the highest reading in this entire dataset. And it means prices right now are more than 3 times what they were in 1982 when the index was set to 100. If you felt like your grocery bill was punishing you this month, the data just confirmed it. This is what the inflation report actually says. And more importantly, what it means for your paycheck, your mortgage, and your next move. Let's start with the headline number. The CPI. That's the Consumer Price Index for all urban consumers, ticker CPIAUCSL. Came in at 330.293 for March 2026. To put that in context, just 1 month earlier in February, it was 327.460. And back in April 2025, it was 320.302. That is a gain of nearly 10 full index points in under a year. In plain English, the basket of goods the government uses to track your cost of living has gotten meaningfully more expensive across the board. Groceries, energy, transportation, all of it is baked into that number, and all of it is moving against you. Now here is where it gets more alarming. The so-called core inflation reading, that is the CPI excluding food and energy, tracked as CPILFESL, came in at 334.165 for March 2026. Core is actually higher than the headline number, which tells you something critical. The inflation that is sticking around is not just gas prices spiking after a geopolitical event. It is embedded in services, in rent, in the things you cannot easily cut out of your budget. In February, core was 333.512. In January, it was 332.793. That is a slow, grinding upward climb month after month. The Fed watches core inflation more closely than the headline number, precisely because it is harder to reverse. And right now, core is not reversing. So what is the Federal Reserve doing about all of this? Here is the uncomfortable truth. Not much, at least not recently. The effective federal funds rate has been sitting at exactly 3.64% for 4 consecutive months. January, February, March, and April 2026 all print the same 3.64%. Before that, in December 2025, it was 3.72%. November was 3.88%. And as recently as August 2025, the rate was 4.33%. The Fed has been cutting, slowly, since mid-2025, but with CPI pushing to 330.293 and core at 334.165. The question the market is asking right now is whether those cuts were premature. The Fed is in a bind. Cut too aggressively and you pour gasoline on inflation. Hold too long and you risk cracking the economy. At 3.64%, they are currently choosing to hold. And every month that CPI climbs, that decision gets harder to defend. Nowhere is this tension more visible than in the housing market. The 30-year fixed mortgage rate, as of April 30, 2026, sits at 6.3%. That is up from a recent low of 5.98% on February 26, 2026, a low that briefly gave homebuyers hope, but that window slammed shut fast. By April 2nd, the rate was already 6.46%, and it has settled back to 6.3% as of the latest reading. Think about what 6.3% means in practice. On a $400,000 mortgage, you are paying roughly $476 a month in principal and interest alone. At the 5.98% low from February, that same loan would have cost you about $392. That $84 monthly difference adds up to over $1,000 a year, just from a rate swing that happened in 2 months. The housing market is effectively frozen for millions of Americans who bought at lower rates and refuse to sell, and for first-time buyers who simply cannot afford to enter at these levels. So what does all of this mean for your money right now? 3 things. First, do not assume inflation is beaten. The data from FED is clear. CPI went from 320.302 in April 2025 to 330.293 in March 2026. That is a roughly 3.1% gain in 12 months, and the trajectory is still upward. Second, the Fed is not riding to the rescue anytime soon. With the funds rate parked at 3.64% and core inflation at 334.165, there is no obvious catalyst for aggressive cuts in the near term. Third, if you are watching the housing market waiting for mortgage rates to fall back below 6%, the data suggests you may be waiting longer than you think. The rate bounced from 5.98% back up to 6.3% in just 2 months. That is not a stable downtrend. That is volatility inside a high-rate environment. The inflation story in 2026 is not over. CPI at 330.293. Core at 334.165. The Fed frozen at 3.64%. And mortgage rates back at 6.3%. These are not abstract policy numbers. They are the exact forces shaping what you pay at the register, what you pay for shelter, and what the stock market prices in every single trading day. Now you have the actual data. Use it.